Hello, and welcome to this masterclass about CSRD. Today, I'm super excited to host again Michel on this critical topic that is CSRD. So, Michel, do you mind introducing yourself and explain quickly what is CSRD?
Of course, thank you, Fabian, and it's a real pleasure to sit in front of you today. And I think a masterclass is a very heavy burden to carry, but yeah, just let's kind of give a pressure cooker overview of what it entails and how it could potentially lead to a better world. So CSRD is the Corporate Sustainability Reporting Directive. That is the kind of framework adopted by the EU, the European Commission, and that is applicable to approximately 45,000 companies in the coming years. What it entails is that, well, actually, let me just take a few steps back and think of what is the language currently that businesses use in the market to make decisions. It's finance. Finance is the language, and money is the currency. That is the language that many people speak. And well, the European Commission aims to kind of enhance that language, to add to that language of nature, language of society, and language of governance, a good business practice, and ensure that in the decisions that are made in companies, that information is also kind of considered and that weighs into kind of the decisions that are made and ensures in a way that the net zero in 2050, which entails that there's kind of no longer the emissions of carbon in the economy. So kind of that is the logic, yeah, of CSD.
Perfect. And I know it's a huge topic. Can you explain maybe the journey behind CSRD? Why is it different from previous directive and reporting structures?
Well, actually, there has already been a reporting kind of requirement for large companies in the kind of in the EU. TNFD, the non-financial reporting directive, has been in place, and that already mandated companies to actually disclose their sustainability performance. Now, what's new? Well, new is that, first of all, not just approximately, what was it, few thousand companies, 11,000 companies in the EU, and for France, I don't know, a few, maybe 1,000 or so companies are required to report, but now 45,000 companies are required to report. So the threshold for when you need to report has been lowered. So if you have 25 million of assets, 50 million of revenue, and more than 250 people, then if you meet two of those three criteria, you have to report in the years ahead. And that is not just those companies that then are influenced by the new regulation, but also all their suppliers. So it has a huge impact for maybe hundreds of thousands of companies and millions of consumers. Well, that's the first thing that changed. The second thing is that it is now, instead of kind of being standard agnostic, there's actually a prescribed standard, the European Sustainability Reporting Standard, so the ESRS. That's also a big shift. Now there is actually a prescribed standard where you in the past had Global Reporting Initiative, GRI. Some of you may know that. It's kind of the de facto mostly used sustainability reporting guideline. You may have had the IIRC, the International Integrated Reporting Council standard. That was kind of more, kind of six capitals: social, natural, human, intellectual, produced, and financial capital, and the value extracted and kind of created. And you have SASB, a more kind of American-based protocol. So there were these different types of protocols, and you may have had, I don't know, variations of them. And those protocols actually did not have extreme detail necessarily, and companies could get away with their own interpretation more. And what you see now is that there's one actual standard mandated by the European Commission and kind of developed by EFRAG, the European Financial regulation advisory group, the kind of association of accounting bodies of different member states. They were asked by the Commission to embark on the endeavor of writing the ESRS. And that was done by a technical working group and in a kind of multi-year effort, supported by Secretariat and many different representatives of stakeholder groups were writing this or developing this, including accountancy organizations, NGOs, national experts, all sorts of representatives gathered to write the ESRS. And that was then kind of brought forward to the Parliament and eventually adopted by the Commission and the kind of the European Council. And so that is really one framework, very relatively well prescribed, although obviously there's lots of degrees of freedom, but it's also relatively elaborate. There's other changes. It's also a bit more than just transparency. There's clear requirements on policies, on governance, on strategy to disclose at least. And you can actually understand that may also lead to actual changes in policies and decisions. But there's much more kind of depth into the actual substance. And there's also digital tagging, XBRL, that is a kind of financial reporting language, taxonomy kind of structure, where all the information that is disclosed in reports will be machine readable. And that means that can be unlocked for the European data cloud. It's called the Single European Point of Access, the SEPA project. And in 2027, that information of these reports will be kind of stored in one cloud that is owned by ESMA, the European Single Market Authority, and that then will be provided to rating agencies and other kind of institutions. And that can make it quite comparable how the performance is on sustainability for the different European countries. So, the vision is clear, transparency, comparability, and also ultimately integrating non-financial information or social, environmental, and governance information into market transactions. And that is all supposed to be contributing to the net zero transition.
Awesome. And maybe because I have this question quite a lot, like to be very concrete, like behind CSRD, it's a set of KPIs that people have to provide. I mean, can you maybe, explain it? Because, it always seems vague.
I can open the actual standard, so the ESRS, and mind you, there's so many 4-5 letter kind of abbreviations. That's kind of a sometimes you can kind of get dizzy of all of those different 4-5 letter word abbreviations, but well, it's a new language, so let's just try to learn them by heart. So the ESRS, that's the name of the standard, the European Sustainability Reporting Standard. And that basically is a set of documents, so to say. And key documents within that set are two kind of, call it encompassing documents, which basically of those two, there's one that sets the kind of definitions. For example, what does a value chain mean? Or what does materiality mean? There's clear descriptions of what it entails. And then there's a second document that is kind of encompassing, and that is a document that gives disclosure requirements that any company needs to entail, regardless of whether information is material or not. And material means decision relevant for either investors or stakeholders. And that, for example, is a prescription of how you should describe the process of the materiality assessment that these companies are required to do, or the actual disclosure of that materiality assessment itself. So that is the two kind of overarching documents that any company needs to, kind of stick to, consider. And then there's 10 topical standards. And topical standards meaning standards on environment, social, and governance. Of those 10, there's 5 environmental: climate, pollution, marine water and marine resources, biodiversity, and finally circular economy, resource and circular economy. And on the social side, there's 4: own workforce, workers in the value chain, local communities, and finally consumers and end users. And then finally, there's the governance standard. Now, what you see is that the environmental ones are kind of structured according to issues, or kind of, these environmental fields that seem to be pretty kind of mutually exclusive and collectively exhaustive, with some overlap. So it's not actually kind of completely mutually exclusive. But the nice thing is that if there's overlap, you can make that explicit within these topical standards, and there's no kind of duplication required. On the social side, it's more structured according to stakeholders, and that seems to be pretty mutually exclusive and, fairly collectively exhaustive. There's maybe things that are overlooked that you can then incorporate. There's also entity-specific topics that you may consider in your materiality assessment, and it's obviously for any entity to report on things that they want to report on that they don't feel are requested. But these this is kind of the structure of these documents. And the governance one really is about any bribes, good business conduct, and one interesting one is animal well-being, and it's also incorporated there. Now, what is very important to understand is that whether or not you have to report on these topical standards depends on the materiality assessment. And therefore, the materiality assessment is considered probably the most important part, the most important step, because that is actually the question: is information something that is relevant? And relevance is defined according to 4 criteria. Is it sufficiently and then on the impact side, there's 4 criteria. Is it sufficiently severe? Does it have sufficient kind of skill? Is it something that is actually kind of likely to occur? And is it irremediable? And that irremediability is kind of, can you restore it or not? And if you cannot restore it, it's considered kind of more relevant for stakeholders. And so those are kind of stakeholder criteria. And then on the what is also interesting, and by the way, I forgot to tell that is actually something that is really nice about this, and that also kind of makes it stand out compared to other kind of typical reporting standards, is that there's double materiality. And double materiality meaning that you also need to consider what is it actually in terms of purely for stakeholders, so stakeholder material, and to what extent it is actually critical from a risk perspective, from a bottom line perspective. Does it kind of lead to a reduction of cash flow, reduction of costs, a reduction of cost of capital, or an increase of cost of capital? Or maybe it creates some positive, business, financial business opportunities. If that's the case, then also it's considered material, but then from a financial kind of perspective. So impact material, financial material, and those 2 criteria, if you have either of those 2 meeting a sufficient a threshold of sufficiency, then you are supposed to then look into the actual topical data points. And those topical data points can be up to more than 1,100 or so. And that includes qualitative or kind of narrative, semi-narrative, and more kind of quantitative data points. So that is if you kind of unbox the ESRS, so to say.
No, super clear. And just a big disclaimer, because it's so complex that you have created the CSRD Academy to help people figuring it out.
That's true. Exactly. Yeah, we have trained over 500 individuals in less than a year in CSRD, professionals from the largest corporations. Actually, some of them even fly in from the US, lots of people from different European countries, but also many Dutch people who are we are based in the Netherlands, and indeed, we do a CSRD in one day as a e-learning and also in classroom. In company also, lots of financial professionals, teams from all over the world that now need to kind of find a common standard, for example, on the scope 3 carbon emissions. They never had to do that, and now they suddenly have to come up with, okay, if we have some flights for our executives that may fly all over the world, and to what extent do we not report on it? What is then the data assumption behind that? Can we have a procedure for our finance and control department? And can we have a data protocol? Those types of nitty-gritty details are now suddenly at the plate of financials in the organization. So yeah, there's lots of need for some, call it, education on that. So super exciting.
Oh, for sure.
Yeah.
And people, go check it out. It's really a great training. It's called CSRD Academy. And just
CSRDacademy.com.
And to come back on what you say, it's the double materiality. I think it's quite innovative, and I think it's probably the first continent, talking about that. Like, okay, you have your financial stakeholders, but you have, you need to treat planet as a stakeholder, kind of, and you need to put that hopefully at the same level. So I think it's quite a big difference for sure.
Absolutely.
One thing, and I don't know if you put that behind the CSRD, it's about the due diligence, because you do your reporting, that's fine, but then the next step is to do the due diligence.
Yeah. Now, so that's a good point. CSRD really is kind of focused on transparency and stakeholder transparency. And then if you really want to kind of have an impact of that and have transformation, meaning, a actual reduction of carbon emissions, or a reduction of underpayment through adequate wages, for example, in value chains at the side of a supplier. If you really want that, CSRD is not necessarily requesting that, right? It's just transparency. So you need to have additional things. Now, on the one hand, you can think of, fiscal incentives. Take, for example, if for large corporations, the scope 1, 2, and 3 carbon emissions are transparent and the data is readily available, then you can have fiscal authorities make, for example, impact adjusted taxes, right? For example, profit taxes. That's an example. And there's lots of incentives you can envision under the context of transparency of natural, social, and governance information. That is an example of an incentive. There's also stakeholder demands. When it becomes transparency, stakeholders can claim their rights. They can claim improvements, and they can, express their concerns, or also the gratitude to headquarters of companies and say, hey, why don't you make sure that the pollution that we as a community suffer from is halted? Or why don't you make sure that the microplastics that's kind of discharged into our river basin is halted? So there's also another nice possibility there. There's many things you can think of that can kind of set things in motion. For example, the investor community, they can actually consider from an impact investing perspective the impact materiality and relevant investing criteria, and they can kind of make the cost of capital more expensive for those companies that are kind of, lagging on certain environmental or social and governance criteria. And finally, you can also think of kind of litigation risk from a legal perspective. That's all nice and clear. But there's another package that the European Commission considers, and currently that is in the final phases of potential adoption. It could be kind of cancelled. The European Parliament still needs to vote as it stands. Maybe when you look at this, it has been adopted, or maybe it's been kind of pushed aside. But that is the Corporate Sustainability Due Diligence Directive, the CSRD, as they say. And that is a really remarkable piece of regulation. There was actually Lara Walters, a member of parliament for the Social Democrats, that championed this. And it's really an interesting kind of package that asks for companies, just in very brief, if you have the infringement of human rights in the value chain of your business, then you have a duty to respect, and that entails also undertaking remedies if that occurs. And then you have kind of the duty to undertake remedies. And then you have to provide transparency on that and undertake action. And well, that is kind of considered due diligence in this context. Actually, Germany has already embraced such package for very large companies, Siemens, Volkswagens, and the likes. And in fact, if they don't fulfill that piece of regulation, if they don't comply, they face sanctions. I think 1 or 2% of their revenue then needs to be that will be incurred in terms of a fine. So that is very interesting, and also from a kind of human rights perspective, a promising development, and that can kind of give a bit more sanctions. As you can imagine, the large business representative groups, or the business representative group at the European level, they were fiercely resistant to this, meaning they have kind of watered down with their kind of influence lots of the more, call it stringent sanctions, such as, call it executive liability. That's kind of no longer there. But still, there's a lot of resistance. And one of the most recent developments under the European presidency of Belgium was that the threshold for eligibility has been kind of heightened, and now it's only for the current package is only applicable for companies that have 5,000 or more employees. So that is not so many companies. That is kind of a way to shield off, particularly the larger and smaller enterprises from additional administrative burden. Is it fair? Well, it's up to, I would say, the listener or viewer to decide that. In any case, there's lots and lots of regulatory changes now that is coming to many companies in Europe. And I think there are, I think, fair concerns with regards to the cost of it all, the predictability of it all, and also the level playing field. If you operate in Europe and you compete with non-European countries and companies, is it fair that you have additional burdens compared to your kind of peers, and therefore also additional cost potentially? So that these are, I think, concerns and fair concerns, and I think it's up to the experts, academia, policymakers, the Brussels representatives, to make people aware and to also ensure that the actual implementation is done as efficient, cost efficient as possible, but at the same time in the spirit of what it requires. Because, overburdening people with administration, and companies in particular, is obviously not what we want. But what is even worse is that there's kind of this regulated greenwashing or regulated human rights washing, right? That there's lots and lots of requests coming from Europe, expensive consultants that then are, implementing that, because companies, in fact, don't really get this or are so hesitant and reluctant that they just want to have the stamp of a Big Four consultant. And, it's kind of a consultancy frenzy. And at the same time, nothing changes. Kind of that's the doom scenario. And in all frankness, I'm actually hopeful. I see that this can actually change. And what's unique is that the financial kind of column, CFO, analysts, controllers, auditors, that they now really kind of join in the sustainability movement very significantly. Also the financial sector, banks, all sorts of investors, they now really want to make sure that this sustainability disclosure and due diligence is taken serious. So I'm quite hopeful, but obviously there's still a risk that nothing really changes, and there's just a lot of red tape and bureaucracy, and then actually the economic performance of European countries is hampered, and nothing in terms of actual impact is done. And in fact, also that the existing sustainability projects are kind of crowded out.
And it's a good transition, because a big question I had for you, it's, do you see the CSRD as an opportunity for companies to create value, directly or indirectly?
It is a total opportunity. And I would say, having been 15 years in the trenches of kind of a more sustainable economy, and really seeing so little progress, such small steps, and so much greenwashing. This is for me the biggest change when it comes to a transition to the sustainable economy. So yeah, I see lots and lots of good things. As I said, um, people who have never been needed in kind of working on sustainability now suddenly needing to chip in. For example, the procurement department, they navigate, they kind of interface with the suppliers, and supplier impact are relevant for example, your carbon emissions or the workers in the value chain. And now suddenly they need to ask their suppliers and do kind of, well, requests and on how is the sustainability ensured in the products that we buy. On the client side, for example, account managers, they now suddenly are exposed or feel exposed if they have clients that may, be very lucrative, but actually infringe upon uh, kind of human rights or pollute the environment. They suddenly now need to get data on that, if that may be the case, or undertake action in the case of the CSRD. And so you see a complete kind of game change, a change of the game, and suddenly sustainability is becoming a critical business factor. Now, what's also interesting is that the regulators, or the kind of financial regulators, are chipping in. And in all the different member states, there was 18 months after the adoption for kind of interpreting the European directive into actual law in the different member states. And different member states have a different interpretation. And what's interesting, France, for example, the financial kind of regulator is extremely stringent. They really require kind of strict interpretation. And if the company doesn't take it serious and kind of makes a mess out of this, the executives could face 5 years of jail time. And above
Wow.
beyond that really goes above and beyond what other countries ask. In the Netherlands, the authorities have expressed the significance of this, and they also say that they will kind of follow through and make controls and checks, but they aren't as kind of heavy, and also the fines. I mean, you can be brought to court ultimately as an executive, and perhaps put out of your position or out of your function, but it's not as stringent as what we see in France. But just to illustrate that, it's a board critical and very material issue, sustainability, which hasn't been the case for so many decades after talking and basically, in all cynicism, greenwashing.
And for sure, and I think you mentioned transparency. I think transparency will bring a lot of those hidden things that we had in the past into the public space, because the minute that CSRD will be implemented, I'm sure a lot of association and NGO will just collect all the data and will start comparing. Okay, you are in the automotive business. Why, company A is so bad in CO2, where company B is much better, and then you are in face of your biggest problem, like, okay, you need to explain why you are so bad, and then your stock will completely fall because of this kind of bad publicity.
Oh, for sure, that is inevitable. And then indeed, the mantra is, if you get naked, you better look good, and that is what
Yeah.
many companies understand well. There are some that actually kind of feel, oh, this will be tricky, and they move out of Europe. They move to the UK. They move to Switzerland. They kind of relocate their headquarters. But interestingly, in 2028, they need to also start reporting if they have more than 150 million euros of revenue. So, kind of, there was a trick that the European regulators made to prevent the kind of free riders, but that is
Yeah.
only for those companies that have more than 150 million revenues per year in the EU. And then, there's other kind of ways in which there's kind of these kind of preventing the free rider problem is, for example, they now have the CBAM, the Carbon Border mechanism, and that is to actually ensure, and that is kind of a similar mechanism that could also work for the kind of performance required for CSRD. But what it does is that if a company in its non-EU location does not have taxes on kind of emissions, carbon emissions, then that kind of mechanism will require for specific sectors to actually pay the difference. And therefore, de facto, you have a equal playing field if you actually, as a European buyer, import products outside of the EU. So for aluminium, for fertilizer, for I think steel, a few large commodity products, the actual CBAM is also in effect already right now with transparency, and in 2027 it will be also with actually the fiscal incentive. So these are smart, I would say, policies to ensure that there's a level playing field and that kind of free riding doesn't make sense. But it's still to be seen how that will be done for the CSRD. Will there be some sort of CBAM for human rights performance, for example, or some sort of mandatory requirement, to ensure that human rights are met? And so, but this is just two out of many different European regulatory packages. We have it for tropical forests, for forced labor. We also see a renewed package on kind of criminal law for the natural environment that will be much more stringent. So, and also the detox of Europe, we shouldn't forget, meaning moving away from all these toxic chemicals. And we can be skeptical. We see some kind of pushback from more kind of conservative industries who have a reliance on these toxins. But ultimately, the European Commission has been living up to their promise to actually have a more green and kind of human-friendly, human-centered economy.
Michel, a huge thank you. It was super clear. Again, if you want to go, one step above what you've learned today, you can go on csrdacademy.com. Great material there. But again, a huge thank you. I think it's a great kind of like high-level understanding and explanation of CSRD.
Thank you.